Is the U.S. slowing down? Hi, everyone. Welcome to the Market House. I'm Maggie Lake, and today I'm talking markets with Jeremy Schwartz, the Global Chief Investment Officer at WisdomTree. Hey, Jeremy, it's great to have you back on.
Maggie, great to be with you. Happy Thanksgiving week.
I know it is. I feel like everyone's sort of climbing to the little bit of a finish line, or everyone needs it's a welcome break. Let's put it that way. It has been kind of a crazy couple of weeks, which I think everyone feels who's joining us live on Substack and YouTube. Hey, everybody, it's great to see you. You can drop your comments and questions in the chats, and we'll get to as many as we can, of course. So. I think that a lot of people weren't sure what to expect, but it's strong start to this holiday week for U.S. equities. Anyway, we saw the NASDAQ up strongly, up about 2.75%. Strength in Alphabet, one of the drivers, but the gains were across all the major indices. But Alphabet is a big move. The stock over 6% up over 6% today, over 10% in the past 5 days. That's a monster move. We also had some news on the Fed front coming late in the day. San Francisco Fed President Mary Daly told the Wall Street Journal that she supports a December rate cut. And that is coming just ahead of earnings and some delayed economic data we're getting this week. So even though it's a short holiday week, Jeremy, there is a lot going on. So let's start with the economy first before we get to some individual stocks. What is your take on where we are? It feels like the Fed is signaling that they are going to go in December. Are they seeing weakness that we just haven't seen because we didn't have any economic data?
Well, I do think the market started turning around on Friday, partly on the Williams speech saying, implying that there could be a cut. Daly's coming out in sort of in that camp. Like we said on Friday, we do a podcast as well. On Friday morning, as we were reading it live, was this like a very live Fed meeting? Like the Fed didn't know what they're going to do, and they're not. Powell's been in the backseat, letting everybody get their voice heard, saying what they think, but he hasn't put his foot on the pulse. And and our team included has said we wish there was more dissent, that there's too much groupthink at the Fed. And then I think I saw a quote this weekend saying, hey, you wanted dissent? You're going to see dissent. now, coming at this meeting, we might get like four, like there's like a poly market for it. We can get 4 dissents, and that's growing. But like Jim Bianco, our mutual friend, was like, we might get 7-5, like, that you might get some dissents. And that's healthy. It's good to see not just following one track, that we think they were overly following just one narrative. But our view is that they should be cutting, that they are a little bit too restrictive. A normal term structure would be 75, 100 basis points or more. And we're really like not there. You're slightly positive now, but it should be another 50 to 75 basis points more sort of positive slope. So the short-term rate, Fed funds being lower than the 10-year. Okay. And so it was inverted for a while, and that was unhealthy. Around the world, the other central banks are more like that 75 to 100 basis points. We should be like that too. And, it's a risk of being, too tight they don't have to do that. They could be more at neutral. And, we do think they have a little bit of room to cut there.
Yeah. So you're not concerned. It seems like, the tension is always between that labor market, which Daly was talking about, by the way, in terms of her reasoning behind needing a rate cut. She's worried about deterioration in the labor market, which I think is, will worry us all. And then on the other side, this sort of, I don't know if it's confusion or just where are we with price inflation? Like, are the tariffs really no deal? I mean, we saw this sort of what happened in the election. A lot of us have been talking about that. Voters clearly feel like affordability is an issue or inflation is still an issue. So does the Fed, from an inflation point of view, have the room to address what might be a softening in the labor market?
See, the challenge here is that the issues that we have are not things the Fed keeping rates too tight would solve. Tax issues, which is what a tariff is not something the Fed would solve. Some of the service level inflation is not something the Fed will solve. So, housing, being unaffordable housing, even lowering rates is not going to solve that. The mortgage rate, I've been talking about you should have a positive slope yield curve. You could cut and the 10-year goes up. Mortgage rates may not be. To solve housing affordability, they need a lot more housing. That's not something the Fed can do. Now, in our view, the shelter inflation is actually lower than the official number. So that's one of the reasons we think the CPI is even biased a little higher than reality. But, housing is a lot less affordable than it used to be. But when we look at the general impulse of things that the Fed does control, like what is the feeder to inflation? Money supply. This comes back to like why we were very upset in 21 when we were saying they should be hiking much sooner than they did, was the money supply was surging 25%. Now the money supply is not shooting a normal 2 to 3% growth in the economy and 2% inflation. We're undershooting that. We should be at 5.5% growth in money supply figures. We're in the fours, and and sort of bank deposits are not even doing that. So our view is that the inflationary pressures, what's there, are not above normal, and the Fed keeping rates too restrictive wouldn't solve anything. So there are real issues, supply issues, tax issues, but nothing that the Fed keeping rates too tight would solve.
Yeah, that's a great point, Jeremy, because everybody sort of looks to the Fed to save everything. And, we're not in that kind of situation. I also think about healthcare. We've been hearing a lot about childcare being a huge issue that came up a lot with Mondami when he was at the White House, for his meeting with, which somebody just mentioned that, by the way, in the chat, when he was with Trump. So all of those things are not sort of necessarily in the realm of policy, monetary policy. You're totally right about that. And it's something maybe that doesn't come up enough. Are we looking at, do we need that from the fiscal side? Is there any hope for that? I mean, should fiscal policy be working hand in hand with monetary policy?
Yeah, you hear about Fed independence, right? And there's this question, and in certain, you look around the world, and in Japan, there's certainly not a connection, independence between the central bank. You've got the government who sits into the Bank of Japan meetings, and they try to be more closely coordinated. Now, so there should be some, and there's sort of this discussion with Bessent and what is his role? Is he going to be, who's going to be the next Fed chair? And there's some rumors like, oh, it's going to be Bessent at the end of the day. We'll see where the Fed goes on that. But it is a lot of supply issues is in some of these things. And so childcare is a supply oriented issue. And how do we really bring in people to help serve that? Or just lower frictions in the system and regulation that could make it easier. All these things are the housing is a supply issue, medical issue is a supply issue. So a lot of it is supply side changes and regulation changes versus just monetary policy.
Yeah, no, that's a really excellent point. And I think I think it's a sort of a lane that I hope we continue to talk about when you're trying to figure out how to deal with some of these economic issues. So does it feel like risk is back on? Like, does it feel like investor sentiment? Okay, the Fed might be lowering rates. We saw that rebound in stocks. I love the headline. Always beware a headline. I love the headline on CNBC. The S&P 500 rips higher. Alphabet reignites the AI trade. Is Alphabet reigniting the AI trade, really? How are you seeing that?
Well, I'll say, in our own team chats, and again, in our weekly podcast, you could go back. We've been talking about Alphabet from the beginning of the year. It's one that as it was going down, our team was saying we thought it was a very cheap, it was clearly the cheapest of the Mag 7. It was being counted out from a valuation perspective. It was among the lowest priced stocks. We're like, we thought that they had a reasonable shot to actually be the key AI leader, actually. And now, when you look at it now, it's up 80% year to date. The Nasdaq's up less than 20 when I was looking at this morning, and it's separated from like Nvidia up 24, where I think was the next closest, and then you had a bunch of way less. So it's the charts look like Alphabet soaring to the top, everybody else sort of flagging. And there's some real story there. I mean, certainly now a lot of the gains are being priced in. It's not the cheapest anymore. Now that category basically goes to Meta, and we think Meta is kind of also being undercounted. The people didn't like its spend on CapEx, but it actually is a powerhouse also. So I think Meta is taking some of our team's crown for the underappreciated value play within the group. It's hard to call any of them underappreciated given the trillions of dollars of market cap, but at a valuation basis, Meta is now. But Google, Alphabet has been it's been a remarkable story, and there's definitely been skepticism on the whole trade and the people spending on Nvidia chips. Will Oracle their CDS spreads widening? Are they going to be able to meet their debt obligations? And the CoreWeaves and the Neo Clouds, are they going to be able to meet their commitments from OpenAI and others to spend on the NVIDIA chips? And the TPUs that Alphabet trained on for their Gemini 3, I mean, the quote that everybody's quoting from Benioff today, that he's been using ChatGPT for a few years, but it's going to now switch exclusively to Gemini 3 based on how meaningful of an upgrade that was. Helped catapult the Alphabet up even more today. But it has been a powerful story. It's not going away. I think for the broad market, you haven't really seen usage. Like these big tech stars, yes, clearly their earnings are being powered by the AI story, but your random small cap company, which will benefit over time, and actually the users of the technology may benefit even more, because can they figure out how to do, to your point on coming back to the economy, are we able to, you heard quotes from Walmart, will we not hire because we're going to use this technology to do a lot more? And so this year has really been driven by earnings. Like the market has not seen multiples expand as a whole. It's actually been driven by good earnings growth. Now large caps are still beating small caps on earnings, and the question will be, can the enterprises grow earnings by using the AI, and that will keep the spend going. And we're bullish on that story.
You are bullish on that story. You think that so you're not worried about an AI bubble, circular financing, all of the concerns that we were really dragging down stocks for the last few weeks. Do you feel like that was overblown?
Yeah, and I'm even saying like Oracle, which has been really sold off in the last few weeks on the CDS fears. And it comes back to, again, like maybe Google's TPUs are so strong, you have these inference AIs, you don't need the GPUs as much as the training and the whole build out, that Oracle, it surged like 30% on its earnings report. We got this huge backlog, billions, hundreds of billions of backlog, which turns into earnings. Like if these commit, but people are now like skeptical, like will OpenAI and whoever else committed, will they be able to fulfill that commitment? And so people are skeptical, and it surged 34%. It's given it all back. It's now lower than before it reported that big earnings. And so, and that's like symbolic. So people are shorting it. The CDS is widening out. I think that is an overreaction on the downside. I mean, I think that is, that's one of the stocks we like in some of our AI ETFs.
Interesting. We have a Wharton fan, maybe an alum, in the chat, talking about nothing better, stocks for the long run, and he listens to your podcast every week. But making a comment, and I'm curious, he's referring to Professor Jeremy Siegel, of course. We need the professor to call the top again, just like he did in 2000, nervously listening for the professor to write a column in the Wall Street Journal 26 years later. It doesn't sound like you guys at WisdomTree are worried that we're getting near some crazy blow off top, or are you looking for that?
No, and if he's listening to Behind the Markets, he knows we talk about that every week. And the professor, he tries to call it like he sees it, very much. He tries to call all the big pullbacks. He calls it when he thinks the Fed's making big mistakes. He calls it when he sees the real speculative hype. And we'd say today is like half of 2000. If you were actually give me a number, I'd say tech as a whole today is at most half of 2000. And that's very quantifiable. And when he did the op-ed, and I first got to Penn when he wrote, I was in school, I was in his class when he wrote that op-ed. So that's what drew me to working with him, was that op-ed. And in that op-ed, he had 9 stocks, triple-digit PEs, and basically say you could never justify these valuations, these 9 stocks. No matter how optimistic you are on these 9 stocks, you couldn't justify the price. Today in the Mag 7, only Tesla has a 200 PE. And now, Elon would say he's going to have more chips than anybody else in the world, that he's making chips that he was like, you'd seem like a little envious of all the TPU success with Alphabet. It was like, hey, we're going to make more AI chips than anyone else. And we have 10 million, you're going to have 10 million cars out there, and you're going to do inference and AI like nobody else. And you've got the Optimus robots and all the things that's going to go on there. So he's the only one on a future different than his car company today. But everybody else, 20 to 25. I mean, Meta's the cheapest of the Mag 7 now. Alphabet's approaching 30 after this, basically doubling 80% up this year, but still below 30 times forward. I mean, it's still among the cheapest of them. The Nvidia's come down a bit. I'd say Apple in some ways is one of the more expensive in the 30s based on its growth rate profile. But they're at 30. It's not, the whole tech sector back in 2000 was well over 60 times forward earnings. So again, that's the half level. So you understand when we say bubble, like you can never justify. I can justify the 30 because of their growth rates. Now the question is, the growth might not come. Like Nvidia's, there might be real competitors to Nvidia that really infringes on its margin, but that's like, it's not a bubble. It's actually being supported by earnings today and expectations for earnings. And those earnings might not deliver. But back in 2000, you say no matter how optimistic you are, you can never justify. Versus today, it's fairly reasonable why these companies are trading where they are.
Yeah.
And only Tesla is the most reliant on this sort of far different future.
Yeah. Tommy Thornton's in the chat, and I'm sure his ears perked up at the mention of Tesla, because he's often going to bat about that on Twitter and taking the short end of it, of course. So tech looks, not the situation it was in 2000s. In terms of the other parts of the market, I mean, I know WisdomTree always thinks about dividends, and a lot of your funds you have, across the spectrum, including value. Do you worry about breadth of market? Do you see a rotation into other parts of the market? Because it sort of seemed like tech was going to lead us off the cliff, and if we went down, it was going to pull everything down too, as opposed to sort of a rotation into other sectors. What's happening with the rest of the market? Do you worry that the gains are sort of still narrowly concentrated in technology?
Well, part of one of the big charts that we were watching earlier this year is just how much the junk kind of unprofitable stocks were working. If you look at like even something like the MSCI quality index, versus the unprofitable, it's been one of the biggest moves for quality versus low quality. You can say like, where has there been some speculation? Maybe in now things powering the AI story, like some of these nuclear stocks that have no revenue that get to very huge market because you need power. I mean, we need sort of every energy source we can to power all these chips. And so so a lot of these nuclear stocks are soaring with, on things that might take a long time to come to fruition, but you need it. So I think one of the biggest stories that is for sure the junkiness or sort of the unprofitable segments that have been surging. In terms of the things that go beyond the Mag 7 I'd say our flagship value fund this year is one that's grown the most, about $2 billion in WTV, sort of U.S. value stocks with dividends and buybacks. So, it's not a cap weight index. So it's sort of more flat in terms of how the exposures are, but that has a 7.5% shareholder yield today. So basically 2% dividends. They're buying back 5% of stock. It's going through a rebalance in the next few weeks, so the portfolio will change a bit between now what you see today and then when you look at it by Christmas time. But even when I look at what the composition might look after rebound, it's still in the sevens. So it's not going to change all that much in my view. So 7.5% going back to Siegel stocks for the long run. His long-term real return for the market was below 7 real after inflation. 7% real. Today, if you get 7.5% from dividends and buybacks, you need no growth, no price appreciation. Dividends and buybacks alone giving you 7%. I mean, that's a pretty powerful way of getting your return. And even based on his long-term return, that means you can even have a contraction in growth and still get the 7% type return. So to me, there is a lot of places beyond the top-heavy, more expensive part where you can get very good value. And if you just get some uptick on what could be this broader participation story, the Fed cutting rates. Some of these smaller cap companies do need borrowing. They're not like the large caps that extend to maturities or don't even have bank borrowing. They sort of the cutting of rates is very helpful for small caps. And then this margin improvement for people using AI that hasn't actually come to fruition, like people just learning how to use it and get their earnings go up, not hiring as many people next year, but their revenue growth. So you have this operating margin leverage that I think comes in over the next 3 years. And so I do think that's the case for the broadening out story.
Yeah, super interesting. Especially when we're talking about diversification, right? Like, so if you're concerned and if you're in this period where there are real debates about AI and how it's going to play out, and if they're going to be able to kind of recoup revenue on that capex. I think a lot of us, as we turn the corner to the new year, are trying to think about diversification and what that might look like. How are you thinking about gold? So we just talked about value stocks or dividend paying stocks and funds that lean into that. Where are we with gold? We saw that in huge run up. It came off in some of the selling. It was also it's also off its peak. Where are you guys in terms of where that plugs into portfolios? Are you getting a lot of questions about that?
Yeah, and Bitcoin is way off its highs from earlier this year, and there's this Bitcoin gold connection that people call Bitcoin digital gold, which I don't love that term as digital gold, but this idea of that you have this store of value that you
Mm,
can't mine more gold unless we have an asteroid that hits the planet with all sorts of more gold, or we mine in outer space for more gold. But effectively, Bitcoin trades like gold. It has this gold like supply issue. We are one of the as a business today, WisdomTree about 140 billion, and one of the largest gold managers in the world out of our European team, over around $20 billion in gold. So we're one of the leaders in that. In the US, we didn't launch a pure gold by itself strategy because beta is very heavily commoditized. It's hard to differentiate. But one of the things we did do is, how do you add it in portfolios? Like, what do you sell to buy gold? Now, coming back
mm.
to the Siegel's stocks for long run book, Siegel would say we have a 200-year chart where gold did a little bit less than 1% a year after inflation over 200 years. So he always would say, hey, if you're fearing about inflation, buy stocks. Companies grow earnings and dividends with inflation over time. Stocks are your ultimate real asset. But with all the concerns about debt and deficits, and if you're China and you see what happened with Russia and you say, hey, we had all these treasuries that we no longer had access to, maybe we should buy gold instead of treasuries. Okay, so that you see, I think a lot of the move in gold was central banks more so
Mm.
than your average RIA allocating capital. I still think people are under allocated to commodities. Generally, when we look at portfolios from clients, I don't see a lot of gold in it in the US and Europe more. Our team in Europe, in some of their research papers, have argued 10 to 20% in gold and commodities generally is a effective diversifier. Now,
Mm.
again, coming back to what do you sell, one of the things that we were innovating about 7 or 8 years ago was a family called Capital Efficient, where we would combine assets like stocks and bonds. So our capital efficient core is like a 90-60 stocks and bonds, so you can make room for alternatives. But we did that with gold, and GDE is basically large cap equities with gold futures on top. So it's a 90-90
Ah.
combination
In the same fund.
in the same ETF, GDE. You get your
Mm.
stocks, you get your gold, you don't have to sell anything. And so
Huh.
the futures is, I think, a very innovative way to do that. And to me, it's a preferred way to do that. You don't have to give up. It addresses like the Siegel critique of stocks are your ultimate real asset. But if you actually
Right.
have real, questions about the purchasing power of the dollar, like you don't have to go to international stocks to do that. I might love international stocks, and I do think there's some cheapness in around the world. But hey, I don't have to bet on the currencies around there. I don't have to bet on the
Mm.
euro. I don't have to bet on the yen. I could just say I'm going to add gold as an overlay to my U.S. equities, and
Mm.
I think that's a better way than having to sell your stocks to buy gold.
Yeah, it's super interesting. I'm gonna have to check that out. I don't know that I realized that there were some overlays, or things being structured like that. Makes sense given what we've seen, and Jack just mentioned gold, year to date is up 55%. So I think everyone's trying to take a look and see, like, what should my exposure be? Was that just a moment, or are we in a kind of new phase where these concerns, as you point out, Jeremy, about debasement, and your purchasing power, protecting your purchasing power, are a little bit different? And does our portfolio need to reflect that? So that's super interesting to know about. You mentioned emerging markets. Um, I love that you talked to us about Japan before people were paying attention to Japan.
Yeah.
And so, of course, we have a lot going on there. We have a new prime minister. That we've seen some big moves in JGBs, in Japanese bonds, as well as the currency. What's your team saying about Japan? How are you feeling about that area of the world and what's happening there?
Yeah, I mean, Japan has been, one of the places I love to visit, but also one of the biggest allocations in my own personal portfolio for the last decade, and continues to be. I mean, I think it's still one of our top ideas. and we have a few different ways, sort of a flagship DXJ currency hedge Japan we launched back in 2010 with the currency hedge. When you look at international versus the S&P 500, say since Abe came in, Prime Minister Abe came in 2012 with his 3 arrows. We're going to weaken the currency. We're going to invest. We're going to get corporate reform. International has returned like 6 to 7% versus the S&P at 14% a year for a decade and 13 years. Okay, so it compounds to like 150% for international to 500 for the US. That much of a compounding of 7 versus 15. One international fund that's beaten the S&P 500? DXJ. So our Japan fund has beaten the S&P over that whole period.
Why is that? Well, how is that possible?
Currency. So the currency went from 80 to 157. And so, the international and broad Japan has basically done as bad as broad international. It has been, the unhedged missed out on huge gains. And there's a carry trade. So you got paid. Right now, there's still a carry trade. You're paid 3% to hedge today, even after, with the Fed lowering rates and the Bank of Japan raising. So this is like when Buffett bought Japan, he started buying Japan in 2019. I bought all those stocks that he bought, all these big trading companies. And I wrote like 6 or 7 pieces, follow Buffett into Japan. And, we've been telling people, follow Buffett into Japan. And so we did one fund, it's called OPPJ, Japan Opportunities. That is effectively almost 50% in the 5 Buffett stocks. I had a lot of people say, can't you give me an ETF of just the 5 Buffett stocks? And then, it has some currency dynamics. We had some of the other stocks he might like to buy with shareholder yields. Again, that dividend buyback screen I talked about. So we're trying to find the cheap value stocks that are growing earnings, the corporate governance improvers. So Japan still, OPPJ is probably my favorite of our Japan funds. We have 3 different ones. And I still think that's like one of our top ideas.
So has anything changed with the new prime minister, any of the policies?
Well, you see, she's in the headlines right now. You see today even the China story. If you said, what are you cautious of? Like, that's been a hot market. And you can say I get overly hawkish on this stance. But I think the dynamic with China is very challenged. And you'll see these tech stocks like Alibaba today up a lot. You see these moves, and really China is the only country that can rival U.S. tech in the short run and probably in the long run. They do have big players, but the dynamic is very challenged. And what Takaichi said was, we're going to defend Taiwan if they get attacked effectively. And
that seems like a change in tone.
Big statement. And so, I think, one of the themes that we saw in European defense was a hot topic. It's not a small shift. Even if Russia-Ukraine gets resolved and we have peace, the defense spending out of Europe for the next decade is going to be very, very high, because there's a huge commitment to spend. And they were not getting to their defense spend. But I think in Asia too, that's going to be when the next place is. Takaichi is going to bring a lot of spending out of Japan, and it's catalyzing. We've seen India, Korea, they're all going to have to spend more in defense. And that's another top theme of ours as well.
That's super interesting, and something you don't hear about as much as the European defense story. Also in the news today, Trump was tweeting about the fact that he's going to go over to China. He's been invited to China for another meeting with Xi. Xi is going to come to the U.S. later this year for a state dinner. Now, of course, everything can change in Washington these days on a dime. But is there a sense that the U.S. and China's tensions, relationships thawing a bit from the sort of tariff standoff, or is it too complicated? How do you guys feel about China?
Well, I think you had Mamdani come to the White House, okay? And so these are not two friends, but they presented as, however they presented. We're going to have that relationship. And China, obviously, it's a key partner. It's a key global trading partner, but also a rival. And the question, this Taiwan question is the big sore point. And I think Xi is testing him like today of like, what are you going to do? I think there's going to be a challenge. I mean, I think, yes, they what they want to try to come to these trade deals and have some, you saw what happened in the April swoon as real concern about trade policy. Trump's trying to navigate through that. But I think there will be stress points in the relationship with China, and we'll have these visits, but there are going to be stress points. And so I think within the next 6 months, I'm still just not, and 6 months to a few years, I think it's going to be challenging for China, even if you get these bursts of excitement. We get some deals, we get some announcements. It's just not something that I think there's extra level of risk that comes with it.
Yeah, there most certainly is. And I had mentioned, for those of you who weren't listening, I had mentioned to everyone, Michael Nicolaitis has a fantastic Substack out on China. And we've got a bull case. He's written a piece about the fact that he's concerned about what's going on there. We have a bull case coming out, for the record, in the next couple of weeks, either this Sunday or early next month, from Pietro about why he's bullish there. So it's a lot of cross currents in China. It's a story we're going to have to keep coming back to. Jeremy, fantastic stuff. Thank you so much. Really interesting conversation. I'm always interested to hear what you guys are up to, because I know you're sort of innovative and on the, front foot on a lot of what's happening. So super, super fun to hear about some of the latest stuff. So appreciate it. Thank you so much.
Always so much fun, Maggie. Appreciate you having us on.
I know. Thank you for joining us. Jeremy braved the airports during pre-holiday rush. So we appreciate you joining us out of your office, as it were. Thankfully, I don't have to go to an airport, so I'm happy about that. But speaking of the holiday, two things. We are going to be dark for the rest of this week in honor of the Thanksgiving holiday here in the U.S., so thank you very much for that. We'll be back December 1st with Tony. And thank you all so much, all of you who left those really kind comments on YouTube and Substack and X around the Major Notes interview with Jem Carson. A lot of you were talking about how much it meant to you to hear his backstory and how moved you were by it. And it was just so nice. Thank you for the feedback. I'm sure he's loving reading some of them as well. And Craig, I think on X, just said it so well right now. Everyone wants to know what the next trade is, when in actual fact, we are living our own best trade. And I couldn't have said it better myself. So if you haven't had a chance to take the time over the holiday weekend to have a listen and share it to someone who you think might also enjoy listening to it, especially if someone in your life is feeling stuck or uncertain. There's a lot of powerful wisdom in it. So thank you so much, everyone. Have a wonderful holiday if you're here in the U.S. If not, have a fantastic rest of your week and weekend. We will see you again next time. As always, take care and good luck out there.
Thank you.